Obviously, the Kenyan currency, regarded as possibly the worst performing African currency this year, depreciated over 26% year to date. It's inflation, it's global factors, it's a lot of other issues. Is this an aberration? Is this something we're seeing in 2011 and things will get better moving into the rest of the year, moving into early 2012?
Thank you so much. I think definitely this trend, as you said, is the worst, has been the worst performing for the year in Africa. But definitely, increasingly, we are seeing the Central Bank of Kenya coming out to sort of have more control in the volatility and to also sort of put a rein in on inflation. So definitely we'll see a market correction hopefully within the year and perhaps a stabilization by early next year.
The measures taken by the central bank, a lot of people saying a little too late, and basically suggesting that it's created such a gap in the market that it's not correcting anything at the moment. The corrective action is just not taking root. It's not working.
Definitely, central bank's response to the crisis or to the foreign exchange problems in Kenya has been rather wanting. The action has come a bit too late, although it is indeed warranted and it is indeed positive, even though it's late. What we are, at the Institute of Economic Affairs, we are decrying over is perhaps he should have been, central bank should have been more responsive in you know, ensuring that monetary policy actually does the job, especially with the concerns for inflation in the country.
Monetary policy, you know, a very aggressive hike of 400 basis points that we saw at the last MPC starting to take some effect, with the shilling coming down at least nearer the 100 shilling band. But others are saying it's a policy shift that's needed. It's inflation targeting that's needed. Let's not worry too much about the exchange rate. Let's deal with inflation. At 17% and rising, it's not a good picture.
Yep, definitely. You're right. What we continually emphasize is rather than concentrate on a specific foreign exchange rate level, the central bank should be more concerned about having stability at the foreign exchange level, as well as having sort of reining in on the inflation that we're seeing. As you've correctly stated, a lot of the monetary policy that has been taken in the past has been discordant with fiscal policy. And just a couple of weeks ago, I think now they have come to the realization that indeed central bank's monetary policy needs to be in concert and in consistency with the fiscal policy that's being implemented. And I think that's a move in the right direction. And perhaps what we'll see is a market correction in the coming days. Right. As you've already seen with the response of the stock exchange already, the equities are improving already. Inflation expectations are going down a bit, though there's still some major concern. But what we continue to see is that with the beginning of the short rainy season here in Kenya, we will expect to see food inflation, at least the pressures on food inflation will begin to go down. And hopefully that will trickle down to the other sectors of the economy. The
contagion effect, David, of a volatile currency, definitely it's going to impact and has started to impact on the balance of payments for the country. It's just made it very expensive to import for a country that is a net importer. We may be seeing equities recover, but as we heard from Kimati earlier on, the fixed income side of the market is wanting, you know. Yields are at 13%, the rates of return are very, very low, and what you're getting for treasury bills is still far below what the inflation rate is. So for any prospective investors, this is not a good picture.
Yes, actually, that's now the major concern. Our thinking is that we need to look at the contagion effect, begin by looking at what exactly are the transmission channels from which Kenya could be affected by developments in the global world. Specifically look at how the channels through which financial linkages are done. And in this sense, I mean that we have to look at direct financial flows. We have to look at financial market practices, both for the institutions as well as the market players. And we also have to look at liquidity challenges in the global market as well. I think only a view of all of these would help us sort of determine the kind of impact that developments in the global world would have on Kenya's economy.
And David, your views on the finance minister requesting more money for the extended credit facility in light of the fact that reserves are down 3.7 billion. So you effectively have 3.4 months, just 3 months worth of import cover. You really need to boost that war chest to support this currency.
Yes, definitely. I think that has been one of the objectives which central bank has failed to meet because the overall goal is to have four months import cover. So we are seeing them sort of going for this facility so that they can shore up their foreign currency reserves. This is in light of the huge investment together with energy projects currently ongoing in the country, which is expected to have have a lot of import demand. So in that expectation, indeed, that is a good policy. Perhaps it will ease up the demand pressures that are there on the US dollar in particular.